You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music can mean but one thing. We are back. It is Education Wednesday. It is time for us to don our drill instructor caps and our whistles because it is time for Options Bootcamp, what the cool kids call OBC. My name, of course, Mark Longo from the THE, OptionsInsider.com, the place to go for all sorts of great options, content, unusual activity, great earnings, vol data that you really can't get anywhere else, and certainly not for free. And then, of course, links to all of our awesome shows over there. We don't talk about it. Maybe we'll mention a little bit on the show today. In fact, I think we will in a little bit. But we have stuff up on the tubes there as well, so you can always check us out over there on the old YouTubes if you are so inclined over there, listener. So, yeah, it's more than just the iTunes and everywhere else where you normally get your podcast. My name, of course, Mark Longo from the aforementioned website, as well as from the network upon which so many of you are binging these days. And, of course, if you want even more to binge on, who can blame you? You want to join us live for this show. You want to get great pro Q&As. Just had a couple of bangers just in the last few sessions over there, as well as unusual activity for days. There's a lot of it there. TheOptionsInsider.com/pro, the place to go to learn more about all that fun. As we learn who's joining us on the old program today, I'm pleased to welcome on. His streak is unbroken. He is the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, what the cool kids call to Mr. P, welcome back to Ye Old Program, sir.
Well, it's always good to be here, Mark. Looking forward to a lively and exciting show today.
Lively and exciting show indeed. I always ask you folks at the top of the show, if you do like what you hear, throw some stars or a rating or review. This week, actually, I mentioned our tubes. This week's, I can't really throw a rating in YouTube, but a nice comment comes from our YouTube channel, which is The Options Insider, all one word, if you want to go look for that over there on the tubes. Listen, I think at options was taken. That's one of the few platforms we don't have at options. This one just came in from Diva Miss 124, and they just said, great episode, thanks for sharing. And you're welcome. Thanks for listening on YouTube or wherever you get the content out there. We try to make it available on just about every platform under the sun. So if you like it on the old tubes, leave a comment, a like, a thumbs up, whatever helps the algorithm continue to promote that stuff. It helps new people discover the content all the time. As we discover a whole bunch of your questions, it is time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
Let's get into all the fun here with the old mail call. Mr. P, I know you post a vidya or two in your day. Where can folks find all your fun tubes, sir?
We post them to our blog. It's just simply markettaker.com/blog, 2 T's in a row. That's the best place. I mean, we do have a YouTube channel too, but There you get not just our daily videos where I talk about the market and things that are trading, but you also get our written blog posts there as well.
All sorts of vidges going up over there in the land of MTM. So if you prefer to watch your podcast, hey, got you covered over here. Also have you covered with our questions of the week. We're always shining a spotlight back on you folks, listeners, at Options on most of the major social media platforms. In this case, Twitter is the place to go to participate in all of these. Last week, we asked you folks, a question we've been testing you with a couple of times this year to kind of gauge your sentiment. And last time we asked it was back in May. At the time, roughly 43% of you chose cash. We asked it again last week. We said, in these troubled times, where are you allocating the majority of your portfolio? People were writing in with all sorts of esoteric stuff, vol income, everything else. This was very straightforward. This was the standard buckets most people are used to. Cash, fixed income, equities, and then commodities/crypto. And Mr. Dan, without looking, what do you think won our poll? Where do you think the majority of our listeners are allocating their money right now in their portfolio?
I would guess equities, honestly.
You are partially right. It was a tie. Actually, a weirdly exact tie. 35.7% each for equities and cash, sure. They tied exactly. So, kind of weird.
Wow.
I guess our audience is quite literally split when it comes to this issue. And then fixed income bringing up a distant second/third at 19%. And then no love for commodities or crypto. They combined for only 9.5%. Maybe if we ask that again this week, with crypto getting a bit of a rally, maybe that would get a little bit of a boost out there. But yeah, no love for that. This week, Dan, we are asking a little bit different question, more of a 10,000-foot question, telling you to look back at the world of options and to you, in your mind, which product has had the largest overall impact on the options market. I gave you three choices, plus the infamous other. We gave you VIX, we gave you the weeklies, and then we gave you dailies/zero DTE, whatever you want to call them. Of course, we left room for write-ins, and you folks can write in all sorts of weird stuff. Maybe you have a particular product you love. Maybe you really love the binaries when they launched multiple times out there. Maybe you really love another proprietary vol product. Whatever the case may be, write it in. Let us know. We're very curious. Mr. Dan, of those choices, VIX, weeklies, or the daily/zero DTE, which one are you choosing? Or maybe you have a write-in. That would be awesome, too. And then B, what do you think our audience is choosing?
So the bit, just overall, like over the history of the last 10 years or
history of whatever, what has had the largest impact on the options market?
Wow, that's a pretty cool question here, Mark. Boy, oh boy. I would honestly say weeklies.
Yeah, I think until the rise of zero DTE, you could have said the weeklies, right? They were big. I think for me, I hate to give the answer out because it always colors the results, but I think for me, I would go VIX just because it has such a long history, obviously, not even as a tradable product, just as an abstract index. It also gave rise to an entire new asset class, effectively, right? Look at all the vol products we have now that probably wouldn't exist. All your SVIXs and your former XIVs and your VXXs and all the options therein. So SIBO marketing aside, it has kind of given rise to a new asset class, a new kind of way to trade options, and a slew of new products. I would probably put it at that. If you're very recency biased, you might say the minis. What do you think our audience are? Not the minis, I'm sorry, the dailies. What do you think our audience is saying, sir?
Oh, boy. There's always the recency bias. So I'm going to guess that they're going to say zero DTE.
And you would be correct, sir. Just ticked exactly 50% right now. Choosing the daily option/zero DTE, 28.9% going VIX, 21.1% going weeklies. So if you add in weeklies and dailies together, the whole short duration trend, that's closing in on 75%. So people clearly like bite-sized options, just a question of what kind. Intriguing stuff. We have a mention in our chat from Age about the minis. Yeah, the minis. He says, I wish I could mention the minis, but those died quickly. Yeah, remember those? That quick flash in the pan? We did that dance a couple of times, Mr. Dan, and unfortunately, no joy. Maybe if they brought it back now, I hate to say recommend doing it a third time, but it does seem like the appetite for smaller bite-sized contracts is enormous now. Maybe if we did a third bite at the mini apple, maybe now is the time, Dan. What do you think?
I don't know. I do believe that a lot of it has to do with the marketing, and I don't know. I mean, I don't want to be critical. I still have a lot of friends who work at SIBO, but it just seems like, I don't know. I never heard anything about it. And like, why didn't they just pay a small amount to brokerage firms, like pay a half a cent a contract to brokerage firms for every trade that goes up there so that it gives them incentive to list it until they gain ground. It's just like there's so many ways that could have been marketed. And I don't know, like nobody ever even heard that Minis was coming out if they didn't listen to this show, probably.
Yeah, that is indeed the case. I was just thinking while you're mentioning bite-sized stuff, let's take a look at our friends, the Nanos, also another small product out of SIBO. And they've done 1,543 contracts today. But again, bear that in mind. This is a nano-sized contract on the SPX. Their ADV is 2,300. So I guess it has ticked up a little bit. It was 3 to 5 or 10 at one time. And that was mostly Henry trading it himself, his own product. So I guess a few people have grokked onto these. So they're not quite the failure. You would think in this current environment where everything small and bite-sized is super popular, the Nanos might be doing a little bit better, but intriguing stuff out there. Speaking of intriguing stuff, Mr. P, it is time for your very intriguing market taker question of the week. What you got for us, sir?
Yeah, so I actually got this question, maybe a few weeks ago, actually, and somebody was asking, isn't selling puts dangerous? And a lot came out of that question, to tell you the truth. The first thing is, yes. I mean, so is having a fire in your house, but we all have a furnace and a lot of us have fireplaces and stoves and such. As long as you know what you're doing and are careful and do it in a controlled way, it's not dangerous. In fact, it can really enrich your life, whether we're talking about stoves or options. They can be, but I use covered calls and cash secured puts in my cycle recycle trade all the time. It's just, it's a matter of knowing it and really having a solid system down. And, a lot of people fail when it comes to trading covered calls or cash secured puts because they don't look at it as a system. They never have proper training. And so I literally redid my entire covered call cash secure put class, and we just relaunched it. Actually, we're in the process of relaunching it this week. We've actually got a webinar tonight, a special training on my system. So mind if I give a little invite and a plug for that?
I will now hang up on you post haste, sir.
So especially for boot camp listeners, if you want to learn more about the market taker cycle recycle system, the smart income system, we have a special training on it literally tonight and another one Saturday. And another one, I don't know, later this week. I forget when. But you can register for it by going to markettaker.com/reg, R-E-G, like short for register. And that if you register for tonight's, you'll also get an invite to the one later this week, too, if you can't make this one.
So there you go. If you're listening live, you can get in there. If you listen on the podcast, it's released later today, you probably have time to get in there. Definitely for the ones later this week. Depends when the podcast hits the network. Later today. Let's get out to some of the other questions out there. Let's go to Crazy 8. By the way, it's like our chat mentioning nanos, talking about nanos dying quickly. I guess they have. The volume is better than I thought. I was expecting another 25 to 50 contracts a day. So 2,300, again, it's nano size. So take all that with a huge grain of salt. It really is just a handful of regular contracts at the end of the day, but it's not nothing. So that at least is, they continue to chug along. I'm with Dan. They need to put a little bit more muscle behind these things, I think, outside from Henry talking about them. That's kind of really all there has been. But intriguing stuff here, nonetheless. Let's get out to some of what you folks have on your brain, listeners. Let's go first to Crazy 8, KRZY8. Wants to know, does the pattern day trading rule apply to options as well or just stocks? Ah, yes. Pattern day trading. We try to stay away from all the regulatory minutia here on the show because it's not the most scintillating of stuff, but it is important at the end of the day. So at the end of the day, you folks ask and you shall receive. We are very nice to you folks. You might look this up and you might find a bunch of different people pontificating on this nonsense and having a bunch of hot takes about it. Most of them are probably wrong. So what you want to do in this case is go straight to the horse's mouth. And that's what we did for you. We went straight to FINRA. We said, hey, FINRA, give us the skinny on your pattern day trading. So I will give you the exact scoop from the folks over there at FINRA. They define day trading as a strategy where an individual buys and sells, or sells and buys, the same security in a margin account on the same day in an attempt to profit from small movements in the price of security. FINRA's margin rule for day trading applies to day trading in any security, including options. So there is the short answer to your question. Let me give you a little bit more nuance there as well. But yes, it does apply to options. You can't just sling stocks like a day trader, but then get away with it with options. They go on to say, according to FINRA rules, you're considered a pattern day trader if you execute 4 or more, quote, day trades within 5 business days. Now, here's all the caveats here. Provided that the number of day trades represents more than 6% of your total day trades in the margin account. That's also key. You got to be a margin account for that same 5 business day period. So how they arrive at that 6% number, I don't know. The voodoo of this stuff is sometimes beyond human analysis, but that's what it is. So here are the requirements. If you're a pattern day trader, you must maintain a minimum equity of $25,000 in your margin account on any day that you trade. And that's kind of the magic number you have to key in. If you get above 25 grand in your account, a lot of this stuff is behind you. You don't have to worry about it as much. This is really more for the lower level accounts. They're trying to protect brokers from the swings that could happen in a lot of these accounts. So if you drop below that level, you won't be permitted as a pattern day trader. Once you're flagged as a pattern day trader, you won't be permitted to day trade again until your account is restored back up to that 25,000 minimum equity level. And they talk about how they calculate that with positions and cash balances. And there is more nuance therein. I encourage you, if you want to dig into it, Crazy 8 and anybody else, I would go straight to FINRA, finra.org. Don't mess around with anything else. You can also ask your broker. They should have a pretty reasonable handle on this stuff as well. But Mr. Dan, you must bump into this a lot. What do you have to say for Crazy 8? We have just established that it applies to options, but any other maybe hints or nuances or bits of wisdom or words of advice you want to pass along as it regards to pattern day trading and options, sir?
Yeah, I mean, it's in a lot of ways, it's a tough rule. And it helps traders in a lot of ways, but it hurts traders in a lot of ways too, because it can be really difficult to implement good risk management tactics. I mean, geez Louise, if you make a mistake and accidentally buy calls instead of sell calls or something, you're not allowed to trade out of it. You're just kind of screwed. So you just got to be really careful. In a perfect world, put more than 25 grand in your account, but that doesn't work for everybody. So just make sure that if you are below that threshold, that A, you're very careful not to make mistakes that you have to reverse, and B, that you have a trading style that doesn't require you to close things that you open the same day.
I knew this would bring up a whole can of worms. I love our members. They're savvy folks, Dan, and they mentioned that in our chat here that the flag can be removed. That's worth noting. Looks like they allow the brokers to remove, once they flag you as a pattern day trader, they can remove it from your account once every 180 days. So if you keep bumping into this, apparently they can remove that. But one of our listeners here in the chat, Age Delaquare, says, day trading rules are going to change next week. You cannot wait out the 90-day day trading flag if you're under 25,000 if you have used the one-time flag removal. So he's saying the flag can only be removed once. So again, this kind of gets into the weeds I was talking about, Dan. There's a lot of nuances therein. So definitely check finra.org. Definitely confer with your broker. They're the kind of boots on the ground for this with you here. But yeah, there are a lot of nuances. Once you get flagged, what happens to your account? Once you drop below 25 grand, what happens to your account? Can you get that flag removed? What is the time frame on that? How long does that last? There's a lot of nuances there. And so if you just come into the show, you're kind of new to options. Maybe you got $5 grand in your account. Hey, good for you. That's a good start. but you may find yourself bumping up against some of these, especially if you're out there. I mean, Dan, we're always talking about zero DTE, right? If these folks are slinging in and out daily options, that might be something they bump into pretty quickly. What do you think?
Yeah, I mean, that's true, man. And, you know, like I've traded a fair amount of zero DT stuff, and with some of the strategy, the plan is to just leave them through expiration, which with many other trades I never do. But geez, you know, like there's every once in a while where you have to pivot and take risk off the table. So it makes it pretty hard to trade those zero DT stuff.
It is amazing that they've had the growth that they have, given all these hindrances in their way, right?
Yeah.
A lot of people slinging these things are very new to the options game, probably don't have 25 grand in their account. So you'd think this would be more of a hindrance, but $1.5 million plus contracts a day just in this stuff every day in SPX. Shez, the answer is no, but we shall see. Dan, all right, put your answering pants on. We got a long one here from JT. Strap in. All right, JT wants to know, he has a question about cash secured puts. He says, I'm thinking through my first cash secured put trade and I had a question. I want to offset some losses in my account and establish a new position in NVIDIA closer to its current approximate 50-day moving average, which he says is around $400. I don't remember when this came in, this question. He says, using a cash secured put, I have sufficient funds to cover the entire purchase if exercised. Okay. He says, if I write the put for a far-dated expiry like December of 2023, and it is exercised prior to that date, first off, probably not going to happen there, JT, but we can get to that in a little bit. I will collect the current approximately $3,000 premium and own 100 shares of the underlying at approximately $400. If one of my goals is to offset losses, why wouldn't I just write the put for an even further expiration and collect an even bigger premium? What am I missing? Am I making a huge assumption that the long put holder will exercise if NVIDIA falls to approximately $400? Short answer, yes, but again, we'll get to that. Won't the option, he puts in parentheses, won't the option be automatically exercised if it is at the money or in the money? No, not unless it expires in the money. That's, again, we can get to that. Or am I incorrectly assuming that the premium I receive will reduce my losses when in reality it would only reduce my cost basis of the assigned 100 NVIDIA shares? And he puts in parentheses 100 NVIDIA at $400 minus the $3,000 premium would be $37,000. Yes, that's the much better way to think of it, JT. Think of it as reducing your cost basis for buying this stock, not as some magical cash machine that is going to erase. You don't say what your other losses are on. I'm assuming it's not in NVIDIA, it's in something else. And now you're trying to sell a put in NVIDIA to cover those losses in something else. And so you're looking at those premiums and you're getting lured to the dark side and saying, the farther out I go, the more money I make on this put. So why don't I just go out infinitely and sell a put as far out as I want? So Mr. Dan, what are your thoughts on this? He's lost money in something else. He's trying to make it back by buying NVIDIA around $400. And he's seeing the put premiums get bigger as he goes farther out. So he says, why don't I just sell a whopping one a couple of years out and cover all of my losses, sir? What's wrong with that thinking?
All right. I mean, I got a lot to say here. I could go into soliloquy mode here if need be.
Well, this question is a soliloquy, so it might require a soliloquy response.
Yeah. Generally, for future reference, I anyway, maybe Mark too, I encourage shorter bite-sized questions because I have the attention span. Oh, look, there's a squirrel out there. Hold on a second. Oh, wait, what was I saying? Yeah, so shorter questions are better, but today I'm very, very focused. I took my Adderall. So there's several things here. First of all, if the loss is in NVIDIA, you could run into the wash sale rule. And so look into that. That's not something that I figure I ever really come up against too much. And so I forgot the exact details there. But I don't know if you'd be able to write a put in NVIDIA within 30 days of selling the stock and still take the tax loss on that. That is something for your accountant. But There is a thing called the wash sale rule. Look into that if the loss is in NVIDIA. Okay, so the next thing, writing a far dated option like December, and right now we're in, geez Louise, it's almost September, but it's still August. Normally, well, it depends on how far you go out of the money, but a lot of the time, if you're close enough to the money, you're way, way, way better instead of selling one 3-month option, selling 3 1-month options or 6 or 7 2-week options, because the theta is higher on those shorter term options, and you get to quote unquote adjust the strike every time expiration comes up, meaning you can roll to a different strike further away from the money if you're trying to skate or not if you're trying to get assigned. So, that I think you could optimize some. And then, writing it further away from the money, further expiration just makes it probably an even worse trade. And then, holy cow, I can't believe I'm still focused enough to go through all this. Are you making a huge assumption that the long put holder will exercise NVIDIA? Mark alluded to there being an answer to this. So, yeah, you're making not just a huge assumption, but an incorrect assumption. The puts only get exercised early for a couple of reasons. One is if they're so far in the money that there's almost no time value left to them. And the reason for that, and so therefore close to 100 delta. And the reason for that is because when market makers are long those puts, and if you're selling them, somebody on the other side is long them. When they're long them and they're 100 delta, they're holding stock, at $4,000 per every put, right? That they're paying interest on, or at least opportunity cost on. So if they're not giving up much time value, they'll exercise them early. But they've got to be pretty far in the money prior to expiration for that to happen. If they're in the money at expiration, then yeah, they'll get assigned, but that's a long way off. I don't think that's what you're asking about. And then finally, will it reduce your cost basis? For example, 100 shares of NVIDIA 400 minus 3,000 premium is $37,000. Like Mark said, yes, that is a great way to look at it. You could look at it the other way, but you can't look at it both ways. You could look at it as, okay, that $3,000 that I take in by selling, one put at $30 or 10 puts at $3, whatever it is. You could look at it as P&Ling that against your loss, but then getting assigned to NVIDIA at $400 and paying $4,000 for it. Like that $3,000 can only be used once. This is not like the riddle about the 3 men with $10. I forget how exactly that goes, but you can't use that $3,000 and P&L it against 2 different things and make it look like everything's sunshine and roses and unicorns. So I think I addressed most of what you're talking about. There's a few logic flaws, a few places where you can further improve and really, really optimize this. And hey, JT, if you're listening live, attend the training that I'm having tonight, markettaker.com/REG. And I think it'll be really super beneficial to you. It'll answer a lot of the questions even deeper than what I just did here.
Yeah, this has been an epic one. So just to summarize for those of you who have the even worse attention span than Dan, if you sell a long-term put in NVIDIA, and let's say it's 2 years out and the stock just drops to 400 in the next week, no one's going to exercise that put. It has to, of course, expire in the money. A penny. It used to be a nickel. A penny in the money now. to be automatically exercised. Think about it. Remember, when you exercise an option, you are surrendering all of that time value. You're just getting the intrinsic value, whatever there is. So if you sell a 2-year out option and then you decide to exercise it next week, you are surrendering a tremendous amount of time value. You would be far better off selling that option in the marketplace and making much more money for it. So you can see economically, there really is no incentive. Unless it's a call, unless there's a huge dividend that overwhelms the amount of that time value, there's really no reason to do it. Or maybe some crazy overnight scenario where your stock's plummeting, you need to get short and it's short sale restricted, something along those lines. Maybe you can exercise a put in that scenario, but really those are very aberrant scenarios. There's almost no economic reason to ever exercise an option like that early. And then, Dan already touched on the cost basis. That's a good way to look at it. Just reduce your cost basis. It's safer than thinking that you're going to print all this money to offset your other loss. All right, that was an epic one. All right, Dan, I guess our theme today is also governmental oversight. We've got this question came in from Gar. I think it got kind of gummed up in our machine somewhere because I think it came in right after all that madness with the contagion back in late March, early April. Somehow just got to us now. So better late than never, Gar. He wanted to know, with all the insanity reminiscent of 2008, what's an investor to do? He puts in parentheses, taxable IRA, etc., with account balances greater than $500,000. He puts in parentheses, cash plus securities. Is one bank more secure than another? Divide up the account into multiple brokers, banks. Thanks. All right. There's a lot of FUD and a lot of just crazy, weird information out there on the internet about this as well. So once again, we went straight to the source for this one. We went straight to SIPC for you. And in particular, a lot of people have this question about the multiple accounts thing. So SIPC clearly spells this out. Let me explain to you exactly. With SIPC, of course, listeners, it's kind of like the FDIC for your brokerage account. Not quite the same, but along those same lines. And then they say SIPC here provides protection for customers in multiple accounts, is determined by what they call separate capacity. Each separate capacity is protected up to $500,000 for securities and cash, including a limit of $250,000 for cash. So if you put $500,000 in cash in your brokerage account, you're only getting half of that protected. So something to keep in mind. Then they define a bunch of different examples of separate capacities, individual accounts, joint accounts. Here's a couple of examples. I'll just run them off for you. They say Mary has an account in her name at her brokerage firm. She's protected by SIPC up to $500,000. Pretty straightforward. Joe has 2 brokerage accounts. This is the one I think a lot of you might run up against. Each in his own name. So you have an account at TD. Maybe you have an account in IB. You're a fortunate fellow or lady. You have a decent amount of cash. You have $500,000 in each. For the purposes of SIPC protection, Joe's accounts are combined, and Joe is protected by SIPC only up to a total of $500,000. So in this case, who asked this? This was Gar. If you had more than $500,000 and you spread it out, and it's both regular brokerage accounts under your name, not going to protect you. Now, if Joe and Mary are married, they could each have individual accounts, and they get protected $500,000. They could have a joint account. That gets protected $500,000. So in that scenario, you can get up to $1 million individually of protection. Also, if you have a Roth and an IRA at the same brokerage, Joe has a Roth account and an IRA account at the same brokerage. Joe is protected up to $500,000 for the Roth and up to $500,000 for the IRA. So you can get multiple accounts protected. It just kind of depends on the very specific definitions of separate capacity that SIPC has. So once again, you can kind of get lost in the weeds in this stuff. As with all things, we encourage you to go to the source, in this case, SIPC directly. So if you fall in one of those scenarios, that's how they break it up. Mr. Dan, I'm sure you probably got a lot of questions along these lines. Post-March, post-contagion madness. What do you counsel the people who are worried about their balances at their brokers?
Yeah. This is obviously not the scope of options boot camp, but it is something that I've come across just being in the trenches for 30 years here. If you follow some of these things that Mark just mentioned, you'd be good for up to $1 million. But, if you have more than $1 million, especially significantly more than $1 million, what I would recommend is looking into your bank. If you can read financial statements, which a lot of people can't. And so, no shame if you cannot. If you can read financial statements, dig into the ones where you have your brokerage account, and make sure that they're solid. And it's tough to know that, especially if you're a layperson reading these things. If you cannot read them, and if you just want a second look, go and see what analysts say about it. Really dig in, because there's a lot of bozos who just say, "Oh, it's a great company," look for somebody who really knows what they're talking about. Some of the people on Seeking Alpha are really, really good. Some aren't, but some are really great. And make sure you know. Oh, and one other thing, and this one, honestly, I'm not 100% sure of, but make sure that your funds are insured by SIPC, which I'm not sure if by law all of them are, because people make the assumption that your bank account is insured by the FDIC, but as we just learned within the last year, some of them actually aren't. And so, even if you just have like a savings account at a bank or whatever, like you need, or a CD or what have you, now that interest rates are higher, these are questions that seem obvious. Like it seems like the answer is so obvious that you're embarrassed to ask them, but ask those questions. Are my funds insured by FDIC if it's a regular bank, SIPC if it's a, brokerage account, and make sure you know. And I guess if you're going the route where it's you are married and you can do a joint account with your spouse, make sure you're nice to your spouse because, you could have your own little personal financial crisis if you're not.
Yes, that's a very big crisis then.
Yes.
That's also beyond the scope of this show. We are not marriage counselors here on this show. Well, Mr. Dan, we kind of dug into all sorts of dark and disturbing weeds here on the show. So let's get out of here on some fun, on a little bit of love. This comes from Shane, a.k.a. Sergeant Kevlar. I like that handle, Sergeant Kevlar. I like that. He just wrote in on our last episode to say, I really appreciate the most recent episode of OBC. It was an extremely thorough answer to my question a few weeks ago. He's talking about our episode about revisiting risk reversals, Dan. As I recall, I think Shane might be the one who wrote in with that initial question about risk reversals a couple of weeks ago, which kind of inspired all this discussion about risk reversals last couple of weeks. So there you go, Shane. I'm glad you got a lot out of it. Hey, you inspired a lot of good conversation on the show, so we thank you for your great question. At the end of the day, if you're thinking about it, chances are a whole bunch of other people have that same question, so it's always good to bring this stuff up. So there you go, Dan. Another satisfied customer. What do you say, sir?
Yeah, that's great. And honored, humbled. The positive feedback is what keeps me going anyway. We put in our time, and as long as people are getting good stuff out of it, I will keep putting in my time. I love to do it.
So thank you, Shane, and everybody else who takes the time to listen. Thanks to all of our live listeners. People are excited. Yeah, P&L Man back in there. Good to see P&L Man. Nichols saying, P&L Man, good to see you survived the storm. Yes, they were a little worried about you when you dropped off right when the hurricane was approaching yesterday. We know you're somewhere in the Florida region. Glad to see you're back on, doing well there. Folks saying, you guys are the best. Thanks for another great show. Well, you're welcome, Option God. Age asking, exercising a leap in the money early. Why would someone do that? Short answer, they wouldn't. I just kind of laid out the reasons why. You lose all your time value. And except for capturing a dividend, which is more than the value of that time value, effectively, or in some weird, aberrant after-hours scenario where the stock's just cratering and you can't get short for some reason, short sale restricted, whatever it is, and you need to get those short deltas in, maybe you would do it then. But outside of those two relatively aberrant scenarios, you really would never exercise a leap early. Nichols, I hate pattern day trading. Yeah, I'm with you. I think everybody hates that pattern day trading rule. A lot of good stuff. Damn, we went in some interesting directions we don't normally go on the show, but that's the one I love. When the listeners take the reins, Dan, because you never know where they're going to take us. Absolutely. All right, Mr. P, if folks want to check out, give them one more plug for that seminar you have going on tonight, and then they want to check out everything else you got cooking in the land of MTM, where should they go? What should they do?
You can, definitely attend the training tonight. And again, if you can't make it tonight, register for it anyway, and you'll get an invite to the encore version of it. But it's all on covered calls and cash secured puts, and a whole lot more. And that's at markettaker.com/REG, short for register. So market as in stock market, taker as in take what is rightfully yours, 2 T's in a row, markettaker.com/REG, and I will see you tonight.
There you go, listeners. Check them out, markettaker.com. Don't forget the second T for Theta. That's going to do it for the live here today. Hey, a rare day of rest for my voice, so I thank the producers for being kind to me after back-to-the-back multiple show days. Back again tomorrow. I will be live over there at the SIBO with our buddy the Flowmaster, talking all things options on the option block there at noon tomorrow for all you live folks. After that, coming back probably a little bit later because it takes me a little bit to get back from the SIBO to the studio here. So probably closer to 2 p.m. Central for This Week in Futures Options. That'll be a fun one as well. Back again. Oh, we got our old buddy Miss Carly Garner joining us again, so that should be fun. And then, of course, going out on Friday, noon Central, volatility views. After that, exclusively for your pro folks with options oddities. Remember, if you see a weird trade, something that makes you go, or just a trade you'd like us to talk about on that show, hit us up on the pro hotline. We'll get it into the show. We could talk about it, analyze it, maybe laugh about it together with you on the old show. If you missed anything, of course, on the pro side, get it on the pro podcast feed. And then for the rest of you, we'll see you back here next week, another episode of Options Boot Camp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.